In this video we are going to learn CMA USA Part 1, Section A External Financial Reporting. Unit 1 The Financial Statements. We know there are 5 financial statements. In this video we learn about balance sheet. Let's begin with a very important topic: financial accounting. So, what is financial accounting? It's the process of recording, classifying, and summarizing financial transactions. But why do we do all this? To prepare something very important: financial statements. Let me put it simply. Imagine a business as a big machine that earns, spends, borrows, and invests. Financial accounting is like the control panel that records every activity of this machine, and at the end, it prints a report card. That report card is called the financial statement. Now, let's look at the main financial statements that every company prepares. Balance sheet. This shows what the company owns and owes at a particular point in time. It answers, what is the company's financial position? Income statement. This tells us if the company made a profit or loss during a period. It answers, is the business earning money or losing it? Cash flow statement. This tracks the actual cash coming in and going out. Remember, profit and cash are not always the same. Statement of changes in equity. This shows changes in the owner's investment or the company's net worth. Statement of comprehensive income. This includes the usual profit and also other gains and losses that are not shown in the income statement. Together, these statements summarize the financial performance and position of a business. They are used by investors, banks, and managers to make decisions. So next time you hear financial accounting, remember, it's all about telling the financial story of a business, clearly, accurately, and completely. Now that we know what financial statements are, let's talk about something very important. External financial reporting. So what does that mean? Well, once a company prepares its financial statements, they don't just keep them locked away in a drawer. They need to share this information with the outside world. This is called external financial reporting. It's the process of preparing and presenting financial reports to people outside the company like government agencies, investors, creditors, and even the general public. But why is this important? Because it promotes transparency. Everyone can see what's going on in the business. It also builds accountability. Companies are answerable for how they manage money. And finally, it ensures compliance, meaning the company follows proper accounting standards and rules. In short, external financial reporting helps build trust between a business and the outside world. So remember this: financial accounting creates the reports. External reporting shares them with the world, clearly, honestly, and by the rules. Now you might be thinking, can a company prepare its financial reports in any format it wants? To make reports reliable, transparent, and, most importantly, comparable, companies must follow accounting standards. There are 2 major sets of accounting standards in the world. First, we have IFRS, the International Financial Reporting Standards. Let's break it down. IFRS is principles-based, meaning it gives broad guidelines, not strict rules. It is used globally, in over 100 countries. It allows flexibility in interpretation, which can be helpful, but also tricky. It's not used for tax or government reporting, and it gives less guidance, so accountants use more judgment. Now, on the other hand, we have US GAAP, which stands for Generally Accepted Accounting Principles. GAAP is rules-based, very specific and detailed. It's used only in the United States. It offers extensive guidance and has many industry-specific rules. There is strong regulatory oversight. Everything must follow the rules strictly. Even though IFRS and GAAP are different in their approach, in real life, for most transactions, they actually lead to very similar results. So, whether a company is in London or Los Angeles, Tokyo or Texas, the world of accounting speaks different dialects, but it tells the same financial story. Now that we've seen how important accounting standards are, let's talk about why they really matter, and who uses financial information. Why do accounting standards matter? Imagine this. If company A tries to hide its losses, an investor might look at the financial statements and think, wow, this company looks profitable. So they invest money and end up losing it. This is why financial reports must be accurate, no hiding or twisting the truth. Useful, they should help people make smart decisions. Understandable, no confusing numbers or tricky language. And all this is possible only when companies follow proper accounting standards. Who uses financial information, and why? Let's look at some real-world users. Investors. They want to know, should I buy or sell shares? Banks and creditors. They ask, should we give this company a loan? Analysts and business reviewers. They look for strengths and weaknesses. Is the company making profits? Are sales growing? Management. They use financial info to evaluate performance. Are resources being used efficiently? Are costs under control? Government and legal authorities. They check if the company is following the law and paying taxes properly. So you see, financial reports are not just for accountants. They're used by many different people for many different reasons. That's why accounting standards are like traffic rules. They keep everyone moving in the right direction, safely and clearly. Now let's take a closer look at who exactly uses financial information. We can divide them into direct users, indirect users, and also into internal and external users. Let's break it down. Direct users. These are people who are directly affected by how a company performs. Investors. They want to know, should I buy, sell, or hold this stock? For example, before investing, they'll check the income statement to see if the company is actually making profits. Employees. They care about job security and future salary growth. If profits are rising, they may hope for bonuses or raises. Managers. They use financial data to plan, control, and make decisions. Example. A manager uses cost reports to identify where the company is overspending. Suppliers. They need to decide, should we give goods on credit? So they check the balance sheet to see if the company has enough cash to pay for goods. Creditors, like banks or lenders, they ask, can this company repay the loan? They check the liabilities section to make that decision. Indirect users. These people act on behalf of direct users. They don't make decisions for themselves, but help others do it. Financial analysts. They study financial data and give investment advice. For example, they might compare two companies' profits and recommend which one to invest in. Advisors, like tax consultants or financial planners. A tax advisor uses company data to prepare accurate tax returns. Stock exchanges. They check if companies are following disclosure rules. For instance, they'll ensure listed companies report their finances honestly and on time. Now let's also look at internal versus external users. Internal users are inside the company, like managers. They use reports to make strategic decisions and control operations. Example, a manager may analyze costs to reduce waste or increase efficiency. External users are outside the company, like banks, investors, or regulators. They use reports to evaluate the company before forming any relationship. For example, a bank will review financial statements before approving a loan. Now that we've seen who uses financial information, let's dive into one of the most important financial statements, the balance sheet. It's also called the statement of financial position. But what does it actually show? The balance sheet shows a company's financial position at a specific point in time, almost like taking a snapshot of the company's finances on a particular day. It's based on a very simple but powerful formula. Assets equals liabilities plus equity. Let me explain. Assets are what the company owns, like cash, buildings, or inventory. Liabilities are what it owes, such as loans, bills, or salaries. Equity is the owner's share, what's left after liabilities are paid. Let's look at a quick example. A bakery has assets worth $23,000. Liabilities of $10,000. So, equity must be $13,000. Because $23,000 equals $10,000 plus $13,000. The formula always balances, and that's why it's called a balance sheet. Why is the balance sheet so important? It helps us assess liquidity, Can the company pay its short-term bills? Financial flexibility. Can it handle unexpected problems? Solvency. Can it pay off long-term debts? Risk. How uncertain are its future cash flows? Key point to remember. Balance sheet accounts are permanent. They carry forward year after year. So what you see this year will still matter in the next. It's not just a record, it's the company's financial foundation. The balance sheet is one of the most important financial statements. It shows the financial position of a business on a particular date by reporting its assets, liabilities, and equity. The balance sheet has three main parts. They are assets, liabilities, and equity. A simple way to remember it is that assets are what the business owns, liabilities are what the business owes, and equity is the owner's claim after paying off liabilities. The golden rule is that assets must always equal liabilities plus equity. Let us begin with the assets section. Assets are divided into two categories: current assets and non-current assets. Current assets are those which are expected to be used up, sold, or converted into cash within 1 year. Examples include cash and cash equivalents, inventories, accounts receivables, prepaid expenses, short-term investments, and other current assets. When we add them together, we get total current assets. Non-current assets are those that are held for a longer period, usually more than 1 year. Examples are property, plant and equipment, long-term investments, intangible assets like patents and goodwill, right-of-use assets related to leases, and other non-current assets. When we total these, we get total non-current assets. Finally, when we add current and non-current assets, we arrive at total assets. Now let us move to the liabilities section. Liabilities are the obligations of the business. Just like assets, they are also divided into current and non-current. Current liabilities are obligations due within 1 year. Examples are accounts payable, short-term credit, outstanding expenses, dividend payable, and other current liabilities. Adding these gives us total current liabilities. Non-current liabilities are obligations due after 1 year. These include long-term loans, long-term bonds, net deferred tax liabilities, warranty liabilities, and other non-current liabilities. When we total these, we get total non-current liabilities. If we combine current liabilities and non-current liabilities, we get total liabilities. Finally, we come to the equity section. Equity represents the owner's share in the business. It includes share capital, additional paid-in capital, retained earnings, accumulated other comprehensive income, preferred shares if any, and other equity elements. When these are added, we arrive at total equity. At the end, the most important check is that total assets should equal total liabilities plus total equity. If both sides match, then the balance sheet is correct. Now that we understand the balance sheet, let's zoom in and explore one of its major sections. Current assets. So, what exactly are current assets? These are the assets that a company expects to turn into cash, sell, or use up within 1 year or within the company's operating cycle, whichever is longer. Now you might ask, what's an operating cycle? Let's break it down. An operating cycle is the time it takes for a business to buy raw materials, turn them into products, sell those products, and finally, collect cash from the customer. For many businesses, like a clothing store or a bakery, this happens within a year. But for some businesses, like tobacco or lumber companies, the process takes more than a year, because the products take a long time to grow, process, and sell. In those cases, we use the longer operating cycle to define what counts as a current asset. So why does this matter? Because current assets tell us about the company's short-term strength. They show us how much the business can rely on to cover its day-to-day expenses. Examples of current assets include cash and cash equivalents, accounts receivable, inventory, short-term investments. We'll be covering these in more detail next. Alright, now that we know what current assets are, let's break them down one by one, because this category includes several different types of assets. Let's go through them with examples to make it easy to understand. 1. Cash and cash equivalents. This is the most liquid asset, meaning it's ready to use immediately. Cash includes coins, currency notes, checks, and money in the bank. Example: a company with $10,000 in a checking account, that's pure cash. Cash equivalents are short-term investments that can be turned into cash quickly, typically within 3 months. Example: a 2-month treasury bill or a money market fund. 2. Marketable securities. These are investments that are almost like cash, but not quite as liquid. Trading securities, bought to sell quickly, so they are always current. Example: a company buys Apple shares to resell within a few weeks. Available for sale securities are current only if the company plans to sell them soon. Example: a bond held for just 6 months to cover future expenses. Held to maturity securities are current only if they mature within a year. Example: a bond maturing in 8 months. 3. Receivables. This is money owed to the company, usually by customers who bought goods on credit. Example: a company expects $15,000 from customers who haven't paid yet. Even amounts owed by employees or related companies are current if they'll be collected within a year. Example: an employee loan due in 6 months. 4. Contract assets, from ASC 606. These come up when a company delivers part of a service but hasn't billed the customer yet. Example: a web developer builds part of a site and will send the invoice after the full project is done. If the payment is expected within a year, it's a current asset. 5. Notes receivable. These are formal written promises from customers to pay, usually with interest. Example: a 3-month promissory note from a customer, that's a current asset. 6. Inventories. These are goods the company will sell or use to make other products. Examples include raw materials, like flour for a bakery, work in progress, half-baked cakes. Finished goods, cakes ready to sell. 7. Prepaid expenses. These are payments made in advance for services the company will use in the future. Example: if the company pays 6 months' rent in advance, it's not gone, it's a future benefit and a current asset. 8. Restricted funds. For current use, sometimes cash is set aside for specific short-term purposes, like repaying a loan soon. Example: a $5,000 bank balance kept as collateral for a short-term loan. Even though it's restricted, it's still a current asset, but reported separately. So in summary, current assets aren't just about cash, they're about resources the company can use within a year to keep the business running smoothly. They help us judge how quickly a business can turn its assets into cash, and that's crucial for short-term survival. We just finished learning about current assets, things a company expects to use or turn into cash within a year. Now, let's move to the other side. Non-current assets. These are long-term assets. That means the company doesn't plan to use them up, sell them, or turn them into cash within a year or the normal operating cycle, whichever is longer. Let's explore the different types of non-current assets with examples. 1. Restricted cash. Sometimes, a company keeps cash set aside for specific long-term uses, and this cannot be used for daily operations. Example: cash reserved to build a new factory or to repay a long-term loan. This type of cash is placed in the non-current section, usually under investments or other assets. 2. Marketable securities. Long-term, these are investments like stocks, bonds, or notes that the company doesn't plan to use within a year. Example: a 3-year bond that the company plans to hold until maturity. Even if the investment is easy to sell, if the management doesn't plan to sell it soon, it is considered non-current. A few key points. Available for sale securities are non-current if not intended for short-term use. Held to maturity securities are also non-current unless they mature within a year. 3. Long-term investments or advances. These are investments made to gain strategic advantages, like influence, partnerships, or control over another business. Example: a company buys a large stake in another company to form a long-term business relationship. Small diamond. 4. Property, plant, and equipment. PP&E. These are physical assets the business uses over many years. Examples. Land. Note. Land is not depreciated. Buildings, machinery, and vehicles. These are depreciated over time. Leasehold improvements. Amortized. Natural resources, like oil and timber. These are depleted as they're used. Remember, the cost of these assets includes not just the price, but also shipping and installation costs. 5. Right-of-use assets. These come from lease agreements. Example. If a company leases a building for 10 years, it records a right-of-use asset for that property. 6. Intangible assets. These are non-physical assets that are still very valuable. Examples. Patents, trademarks, franchises, copyrights. Goodwill from acquiring another business. If they have a limited life, we amortize them. If they have an indefinite life, like goodwill, we test them for impairment regularly. Important. Internally developed intangible assets, like brand reputation, are not recorded on the balance sheet. 7. Other long-term assets. This is a mix of various items that don't fall into the above categories. Examples include prepaid pension costs, long-term prepaid expenses, receivables from long-term transactions, deferred tax assets, cash surrender value of life insurance policies, contract assets not expected to convert to cash within a year, restricted funds meant for long-term use. So, in summary, non-current assets are all about the long-term strength of a business. They don't help with day-to-day cash needs, but they form the foundation for future growth and operations. They're the big, heavy lifters in a company's financial position. Now that we've covered assets, let's shift to the other side of the balance sheet. Liabilities, specifically, current liabilities. So, what are current liabilities? These are the obligations a company needs to settle within 12 months or within its operating cycle, whichever is longer. And how are they usually settled? By using current assets, like cash or receivables, or by creating other current liabilities. Let's look at the main types of current liabilities, with simple examples. 1. Accounts payable and trade notes payable. This is the money the company owes to suppliers for goods or services it has already received. Example. If a bakery bought flour on credit, the amount owed goes under accounts payable. 2. Cash dividends payable. When a company declares a dividend to shareholders but hasn't paid it yet, it becomes a current liability. Example. A company declares $5,000 in dividends to be paid next month. 3. Contract liabilities. ASC 606. This happens when a company receives payment in advance but hasn't delivered the goods or services yet. Example. A customer pays up front for a website. The service is not complete, so it's a contract liability. 4. Security deposits from customers. If customers give deposits that may need to be returned within the year, these are current liabilities. Example. A utility company holds customer deposits for a year. 5. Employee tax withholdings and sales taxes, agency collections. The company collects these on behalf of others, like governments, and must pass them on. Example. Sales tax collected from customers or income tax withheld from salaries. 6. Demand notes. These are short-term borrowings that the lender can demand at any time. Example. A bank loan that must be repaid on demand, usually shown as a current liability. 7. Short-term notes, 30, 60, 90 days. These are formal, short-term borrowings. Example. A 60-day loan to cover temporary cash needs. 8. Current portion of long-term debt and lease liabilities. Even if a loan is long-term, the part that must be paid this year is a current liability. Example. $1,000 due this year on a 5-year loan. 9. Accrued liabilities. These are expenses that have been incurred but not yet paid. Examples. Wages payable for work already done. Taxes payable. Interest payable. 10. Long-term obligations callable due to covenant violations. If the company breaks a loan rule, a covenant, the entire loan can become due immediately, making it a current liability. Example. If a company fails to maintain a required debt ratio, the lender may call the loan early. 11. Assurance-type warranties, portion within next period. If the company offers warranties and expects to pay for repairs or replacements within the next year, that portion is a current liability. Example: a TV company sets aside money for expected warranty claims in the coming year. So, to summarize, current liabilities are the bills, debts, and obligations a business needs to settle soon, typically within a year. They show how much pressure the business has on its short-term finances. Now that we've looked at current liabilities, let's talk about their long-term cousins. Non-current liabilities. These are debts and obligations that a company does not have to settle within 1 year or within its operating cycle, whichever is longer. So basically, if a payment is due later, not now, it's a non-current liability. Let's go through the key types with examples. 1. Long-term contract liabilities. This happens when a company gets paid in advance for goods or services it won't deliver for more than a year. Example: a software company receives payment today for a 3-year service agreement. The part of the service not yet delivered in the first year is a non-current liability. 2. Long-term notes or bonds payable. These are formal borrowings, like loans or bonds, where repayment is due after 1 year. Example: a company issues a 5-year bond. The portion due after the first year is a non-current liability. 3. Portion of loans or lease payments due after 1 year. Even if a loan or lease is paid in parts, only the portion due after a year is considered non-current. Example: a company has a loan of $10,000. $2,000 is due this year, current, and the remaining $8,000 due later is a non-current liability. 4. Pension obligations. These are amounts the company must pay to retired employees over time. Example: a manufacturing company with long-term commitments to pay monthly pension to former workers. This becomes a non-current liability. 5. Deferred tax liabilities. This is a special item. Sometimes, a company pays less tax now but will owe more in the future due to temporary differences between accounting and tax rules. Example: using accelerated depreciation for tax savings today, which results in higher tax in future years. That future amount is recorded as a deferred tax liability. 6. Warranty obligations beyond 1 year. If a company offers multi-year warranties, the portion expected to be used after the first year is a non-current liability. Example: a company sells refrigerators with a 3-year warranty. It must set aside money to cover repairs in year 2 and 3. So, non-current liabilities show the company's long-term responsibilities. They tell investors and creditors about future payments that the company needs to plan for. These obligations might not affect this year's cash flow, but they're crucial for understanding the company's long-term financial health. We've seen assets, we've covered liabilities. Now comes the final piece of the balance sheet puzzle. Equity. Equity represents the owner's claim on the business after paying off all the debts. Think of it like this: equity equals assets, liabilities. So if a company owns assets worth $500,000 and owes $300,000, then the remaining $200,000 is the equity, the portion that belongs to the owners. Let's break down the main components of equity in a corporation. 1. Capital stock. This is the total par value of shares that the company has issued. Example: if a company issues 10,000 shares at $1 par value, then capital stock equal to $10,000. It's a legal value, not the price the shares were actually sold for. 2. Additional paid in capital, APIC. This is the amount investors paid above the par value. Example: if those same 10,000 shares were sold at $5 each, that's $4 extra per share, $40,000 in APIC. So equity grows not just from issuing shares, but from what people are willing to pay for them. 3. Retained earnings. This is the profit the company keeps instead of paying as dividends. Example: the company earns $100,000 this year and pays $20,000 in dividends. What's left, $80,000, goes into retained earnings. This shows how much the company has reinvested over time. 4. Accumulated other comprehensive income, AOCI. This includes gains and losses that don't go through the income statement, but still affect the value of the business. Example: the company holds investments. One of them rises in value, creating an unrealized gain of $5,000. That goes straight to AOCI, not net income. Think of it like a side pocket for other changes in wealth. 5. Non-controlling interest. Sometimes, a company owns less than 100% of another business. Example: if you own 80% of a subsidiary, the remaining 20% belongs to outside shareholders. That's shown as non-controlling interest under equity. It's part of the group's assets, but not entirely yours. 6. Treasury stock. This is contra equity. This represents the company's own shares that it has bought back from the public. Example: the company buys back 1,000 shares at $10 each, that's $10,000. It's subtracted from equity, because it reduces ownership spread and available shares. To sum it up, equity tells us who really owns the company after all debts are paid. It reflects both the original investments and the company's performance over time. It's the net worth of the business, the value that belongs to the shareholders. So, why is equity important? It represents the ownership value in the company, shows how much has been invested and reinvested in the business, used by investors to analyze return on equity and financial health. Together with assets and liabilities, equity completes the balance sheet equation, the foundation of financial reporting. Now that we've understood how equity fits into the balance sheet, let's look at why the balance sheet is such an essential financial statement. It's not just a document filled with numbers, it's a powerful tool for decision makers. Benefits of the balance sheet. It's the basis for calculating return on investment, ROI. Investors and managers can calculate how efficiently a company is using its equity to generate profits. It helps evaluate the capital structure, debt versus equity. This tells us how much the company relies on borrowed money compared to owner's capital. A company with high debt may be riskier in times of downturn. It helps predict future cash flows. By examining the company's current assets and liabilities, we can estimate how much cash will likely come in and go out in the near future. It helps assess financial health. The balance sheet gives a clear picture of the company's solvency and liquidity, in simple terms, whether it can meet its short-term and long-term obligations. Let's walk through a quick example. A company has assets equal to $500,000, liabilities equal to $300,000, equity equal to $200,000. From this, we can calculate a key financial ratio, debt to equity ratio equal to liabilities divided by equity equal to 300,000 divided by 200,000 equals 1.5. A higher ratio indicates greater reliance on debt, which may mean higher financial risk. Investors can use this to assess if the company is becoming too dependent on borrowed funds. So, the balance sheet is more than just a report. It gives us tools to measure performance, risk, and financial strength. But while the balance sheet is powerful, it's important to also know its limitations. And that's what we'll cover next. Let's move forward. Now that we've seen the benefits of the balance sheet, we must also understand its limitations. Why? Because relying only on the balance sheet can sometimes give us an incomplete or even misleading picture of a company's performance. Limitations of the balance sheet. It's only a snapshot. The balance sheet shows the financial position at just one point in time, like a photo. It doesn't tell us what happened in the past or what will happen in the future. That's why we need to use it together with the income statement and especially the cash flow statement to get the full story. It doesn't reflect true market value. Most assets are recorded at historical cost, not their current market value. Example: a building bought 10 years ago for $100,000 may now be worth $300,000, but the balance sheet still shows it as $100,000, minus depreciation. So, the actual worth of the company could be understated. It misses intangible assets. Some of the most valuable things a company owns aren't even listed. These include skilled employees, brand reputation, internal systems, Competitive advantages. These can generate future profits, but since they don't meet accounting criteria, they're not shown on the balance sheet. It includes estimates and judgments. Some values are not exact numbers, they are based on assumptions. For example, how much of the receivables will actually be collected? How long will the machinery last? How much should be set aside for future warranties? These estimates can change over time, which means the balance sheet may lose accuracy. Interest rate changes aren't reflected. Let's say a company has taken loans at a fixed interest rate. Even if market interest rates change significantly, the liabilities remain recorded at their original values. This means the balance sheet might overstate or understate what the company actually owes if those loans were evaluated at today's rates. So, what's the takeaway? The balance sheet is a very useful tool, but just like any tool, we must understand its limitations to use it effectively. It works best when combined with the other financial statements and analyzed with a clear understanding of what's included and what's not.